The bus doors slid open onto a threadbare red carpet, devoid of any fanfare. No marching band, no welcoming handshake from Xi Jinping. Just the choking haze of Beijing's smog, and a small group of mid-level officials waiting silently. Europe's top leaders stepped down like ordinary travelers, stripped of ceremony and dignity. Ursula von der Leyen led the way, her expression firm, surrounded by aides who already knew the message. This summit was never about genuine diplomacy. Plans changed fast. The second day was cancelled. Joint press conferences were called off. The only agreement was a recycled climate pledge, a token to cover the collapse of talks before they truly began. The backdrop was stark. In 2024, the EU's trade deficit with China soared to $305.8 billion, almost double what it was in 2021. Europe came ready to address this imbalance, but Beijing stood its ground. Xi's unspoken message was clear. Europe depends on China, not the reverse. Von der Leyen pushed for a fairer balance and urged depoliticizing trade. But Beijing offered no concessions on Europe's priorities: access to critical raw materials, clear regulations, and reciprocal market access. The European delegation left with little more than formal statements and vague promises. On rare earth materials, where Europe is most vulnerable, China remained unyielding. Despite repeated warnings, export licenses for gallium, germanium, and rare earth magnets remained tightly controlled. Europe's own production is minimal. China dominates over 90% of the EU's imports of permanent magnets, key for electric vehicles, wind turbines, and defense tech. This reveals a deep contradiction. Europe seeks to build independent green industries while depending on China for essential components. It demands China reduce industrial overcapacity while heavily subsidizing its own manufacturers. It expects respect from a trading partner it burdens with tariffs. These opposing demands cannot all be met. China's timing only added to Europe's embarrassment. While EU leaders waited for trade negotiations to progress, Beijing finalized a 20-year natural gas deal with Russia, adding 10 billion cubic meters per year from Sakhalin starting in 2027, alongside the 38 billion already flowing through the Power of Siberia pipeline. Meanwhile, Europe pays 3 times more for US liquefied natural gas. This widening energy gap is damaging industries. German industrial output fell 1.4% in Q2 2025. BASF is closing a major ammonia plant citing high costs. Volkswagen is shifting battery production from Germany to China, and Siemens laid off thousands of workers. Despite these warning signs, the EU persists with an expensive strategy of economic separation. Hungary stands apart. Still importing Russian gas, it has become China's favored EU partner. In 2024, nearly half of Chinese foreign direct investment in the EU flowed to Hungary. Chinese automaker BYD opened a second factory there in June. Meanwhile, Chinese investments in France and Germany dropped sharply. Brussels issues warnings, Budapest collects investments. Von der Leyen's final request, to use China's influence with Russia to ease the Ukraine conflict, was met with silence. No joint statement, no criticism of Moscow. Instead, China announced a fast-track corridor for Russian energy exports, cementing its role in a pipeline Europe abandoned. While Europe was blocked from meaningful talks, American farmers suffered quietly. Chapter 12, Bankruptcies in the first half of 2025 hit a 5-year high. The USDA projects U.S. farm debt will reach $561.8 billion by year-end, surpassing pandemic-era records. A major factor: tariffs on Chinese-made farm equipment, including combines and irrigation pumps. U.S. alternatives are costlier and less accessible, forcing many farmers to delay essential upgrades. In this unfolding story, China's quiet power grows. No grand declarations are necessary. The message is clear in every delay, every broken agreement, every calculated silence. They borrowed at 7% interest, betting on growth. But the equipment wore down, margins thinned, and then the collapse came fast. U.S. soybean exports to China plunged 31% in Q2 of 2025, just as Brazil surged 44%. Pork exports fell. Corn followed. For Chinese importers, American farmers now look like unstable suppliers, politically erratic, vulnerable to supply shocks, and made expensive by layers of tariffs. Trade routes aren't pausing, they're being rerouted for good. Washington's answer? A $20 billion subsidy package sold as relief but mostly soaked up by operating costs. Over 60% of the aid now goes to interest payments, servicing debt, and leasing land. It's not growth capital. It's just keeping the lights on. A bailout, not a reboot. A delay, not a fix. This isn't a supply chain crisis. It's a structural unraveling, a collision of national contradictions. Every player chasing opposing goals while the scaffolding of the system cracks beneath them. Trump says he supports a strong dollar. Then, without pause, he boasts that you make a hell of a lot more money with a weak one. His economic team is now pushing the Fed to slash rates by 300 basis points to undercut the currency. The Bloomberg Dollar Spot Index has already dropped 8.5% this year. But here's the problem. Over half of U.S. imports are intermediate goods, semiconductors, rare metals, industrial components. A weaker dollar makes all of that more expensive. So even if exports rise, production costs climb. Manufacturers are being crushed between spiking input prices and evaporating margins. Caterpillar's Q2 tells the story. Exports up 6%, but material costs jumped 9.4%. Net income fell. Ford, Boeing, and Whirlpool have all issued warnings on procurement pressures. A weaker dollar might sell more units, but it kills profit. Inflation is another trap. Core CPI remains stuck above 4.1%. Food is up. Rent is up. The Fed is trapped. Cut rates and risk an inflation spiral. Or stay tight and watch the White House's trade plans disintegrate under pressure. Internationally, confidence in the dollar is eroding. China, India, Turkey, central banks there have added over 700 tons of gold since January. The dollar now accounts for just 54% of global reserves, down from 61% in 2020. The euro, yuan, and gold are quietly gaining ground. Investors are moving their money. U.S. Treasuries have seen net outflows in 4 of the past 6 months. Meanwhile, demand is rising for Chinese 10-year bonds and Eurozone energy-linked ETFs. No one's abandoning the dollar outright, but they're preparing for life beyond it. The hedging has begun. And as all of this unfolds, Trump's August 1st tariff reactivation looms. If a deal isn't struck, $300 billion in new tariffs will slam into Chinese electronics, European machine tools, Indian pharmaceuticals, and Korean semiconductors. Letters have already been sent. Negotiators are scrambling. Time is running out. But here's the central contradiction. Trump wants lower prices, a weaker dollar, higher exports, and protective tariffs, all at the same time. The outcome? Importers face higher costs. Exporters face weaker demand. The U.S. manufacturing core is caught in a vice, squeezed between rising expenses and crumbling global confidence. Europe isn't escaping either. ASML, the continent's technological crown jewel, can no longer ship cutting-edge lithography machines to China due to U.S. export bans. But China made up 45% of its 2024 revenue. So it ships outdated models instead, losing competitive edge while following Washington's lead. Europe's dream of strategic autonomy looks like fantasy. Defense is NATO-dependent. Industry is China-reliant. Energy is tied to American LNG. And diplomacy, as Beijing has demonstrated, is being quietly ignored. While Washington and Brussels argue over tariffs, interest rates, and global alignment, China is simply moving forward. 10 new Belt and Road ports are under construction. BRICS just welcomed Egypt and Argentina. Yuan-denominated oil contracts are up 22%. A second digital yuan trial has launched in Southeast Asia. Beijing didn't win by attacking the system. It won by letting the system devour itself. Europe wanted low-cost goods without dependence. America wanted protectionism without inflation. Both got the opposite. And as they fragmented, China waited, never needing to rush, never needing to bargain. Now it sets the terms. No concessions, no apologies. When summits are held, it doesn't need to say no. It just watches as the world knocks on its door. Guests arrive, the doors open, and Beijing doesn't even need to speak. It just hosts, while the system realigns around it. So what happens next? If the dollar drops another 10%, do central banks keep buying gold? If American exports rise but profits disappear, do U.S. manufacturers endure? If the EU is neither feared nor necessary, what is its role in the emerging order? Can Trump engineer a weaker dollar without burning down the economy? Can Europe rediscover leverage, or is China already moving beyond the stage of summits, quietly building the foundations of what comes after?